This chart right here is the assets that are held on the Fed's balance sheet. And this is where, quantitative tightening versus quantitative easing comes into play. We saw that pretty much from where it peaked out here in June of 2022, the Fed has been letting assets on their balance sheet roll off, meaning that the longer duration bonds that they have, the debt, when they mature and expire, they are not repurchasing that debt. They are letting it roll off, expire, and they're not doing anything with it. This is different from completely just selling assets on their balance sheet. They're not doing that. That would be like anti-quantitative easing. But quantitative tightening is just letting balance sheet roll off happen. Now, the pace at which this is happening has been changing pretty much since May of last year in 2024. This is where they slowed the pace of quantitative tightening, and they've been guiding this. So as you can see, I can put some white horizontal lines here. See how that was the current rate of change of quantitative tightening. And from May of 2024, they reduce the pace, letting these assets roll off their balance sheet. And in order to do that, instead of letting, let's just say, $500 billion roll off, then maybe you take some of that principal and then you buy more, duration assets in order to offset it. So this is where they were doing less QT, and they were actually starting to buy certain treasury securities. And now that pace has, flattened a lot since then. On March of this year, they, slowed the pace even again. And as they're slowing the pace of quantitative tightening, this is because they are starting to see cracks in the liquidity market. One thing that I can pull up as well on top of this is the reverse repo facility. So as you can see in blue here, this is the reverse repo facility. Right now it's currently at around 19 billion, but just as when the Fed was performing quantitative tightening, this was around 2 trillion. And so I'm going to invert this chart just to show you exactly, what was going on here. And so as the Fed was letting assets roll off their balance sheet, all of the money that was stored up from the pandemic, right? So a lot of the excess liquidity got thrown into this giant parking lot at the Federal Reserve called the reverse repo facility. All of the trillions of dollars from there, as the Fed was rolling assets off their balance sheet, that was being injected into the markets, effectively canceling out the effects of quantitative tightening. That's part of the reason why you had the markets perform very well over the past few years, is because there wasn't really being assets drained from the system. It was being canceled out here.